always searching for best-of-breed plays when powerful long-term themes here, Mad Money, trends like physical fitness. Thanks to the rise of the selfie generation, there's a ton of demand for anything that makes it easier to exercise. For years, I've been telling you to harness this terrific theme with Planet Fitness, the rapidly growing chain of gyms with a laid-back ethos. And for years, Planet Fitness put up stunning numbers, ones that everyone cheered. As a matter of fact, when you think about it, the stock is up 182% since we first spoke to the CEO in August of 2017. But this past summer of our discontent, Planet Fitness peaked. The stock got hit with its first major pullback in 4 years as a publicly traded company, plummeting more than 31% from peak to trough. Now, while it rebounded handily, there's that gentleman, okay? Since then, the shareholders, well, let's just say that there's less conviction that it's the right stock to own. Just as Planet Fitness was plummeting in late September, we got a new way to play the fitness space with the Peloton IPO. Now, this is a company that makes connected exercise equipment. Think high-end exercises with screens where you can stream everything from fitness classes to entertainment. Oh, this little cinema verite here at our house, you kind of have to take down the bask and the other stuff so you can see the screen. But things dry. They dry well on this. It's kind of like a dryer within a dryer. Peloton was widely hailed as a real major disruptor in the industry. I mean, who needs a gym where you can take a class from your comfort in your own home with Peloton? And there was a lot of hype going into this deal. Right after it came public, though, I told you to stay the heck away. Peloton looked too expensive in a market that had turned against turbocharged growth companies with no earnings. Sure enough, in less than a month, the stock fell from 25 and changed down to 21. However, in recent weeks, Planet Fitness has gotten its groove back. You can see this little move up here. It's not bad, right? And Peloton actually seems to have found some solid footing. They both reported good numbers, and both stocks have bounced back hard from the lows. So now that the smoke has cleared, what do we do? How do we stack these up? Do we stick with Planet Fitness as the best-of-breed operator, or is it time to swap into the up-and-coming Peloton, if only just because, well, it's got multiple uses? Right at this moment, I still prefer Planet Fitness. It remains the better buy at these levels. As for Peloton, I think it's too risky to own here, although I can't imagine a future where it actually is worth owning because it's got great growth. Even after the stock's 5.2% run today on the news that it's exploring apps for Amazon Fire TV and the Apple Watch, I want to approach this one with some caution. Don't take my word for it. I want to show you how to make this kind of comparison for yourself. Why don't we start with Planet Fitness? The last time we checked in with CEO Chris Rondo back in March, the company was firing on all cylinders, terrific membership growth, and awesome same-store sales. How do they do it? Well, let's listen to Rondo.
We always say it's the marketing machine, that flywheel effect that we have. We talk about that a lot. 9% of every monthly membership dues goes right back into marketing. So every incremental member fuels tomorrow's joins.
This thing's a little tight, but it's better on the Peloton. All right. That's the kind of thing investors love to hear. Plus, Planet Fitness has a franchise-based business model that makes it much easier for them to expand because the franchisees are practically lining up to open more locations. That is really the trick to profitability. Look at this. See, look what it does. You can straighten it out. You can go like this. I mean, this thing does everything. But then the stock, this one, hit a wall as high-flying growth names fell out of favor with the Wall Street fashion show. Planet Fitness sold off for most of the summer, and then when the company reported a big top and bottom line beat in early August, well, investors focused on the one piece of hair on the darn thing. The same-store sales came in at 8.8%. Well, analysts were looking for a 9. Yeah, can you imagine that's what matters in this market? It didn't even matter that management raised their full-year forecast. Stock got hammered anyway. Sell-off was relentless, with Planet Fitness sinking from 77 down to 56 and over the course of 2 months, even though the fundamentals were totally sound. I know a bunch of you called during this period in the lightning round. I kept saying, listen, I think it's okay. But, wow, I mean, it really got clobbered. All right, how about Peloton? When the Exercycle and Plus company became public at the end of September, it priced at $29 a share then, and then started trading at $27 before closing at $25 and change. That's awful. The deal stunk up the joint because they got the timing wrong. Peloton's got explosive accelerating revenue growth, or R, got up 110% in their 2019 fiscal year. That is great. 6 months ago, the market would have lapped this thing up, but then we got inundated with IPOs that have very similar characteristics. Fast growers with no clear path to profitability and rising costs, especially marketing costs, which at Peloton are growing even faster than sales, and that's something we don't like to see. The stock eventually bottomed at $20 and change in late October. At that point, the weak hands got washed out, and Peloton stock began to bounce, climbing to 24 right before it reported last week. So let's talk about earnings, or lack thereof. Peloton delivered some, let's say it managed to deliver some truly impressive numbers, even if the stock got dinged on the news, briefly pulling back to 22 and change, although since it's recovered those losses. The company's sales came in substantially higher than expected. We like that, up 103% year over year. Connected fitness subscribers also up 103%. Great. Low churn, robust engagement, and much stronger than anticipated margins. Better yet, the guidance was very encouraging. But you know what the best part was of this PTON? On the conference call, Peloton's co-founder and CEO John Foley laid out the strategy. While the company's spending aggressively to boost growth, he said, I believe if we pull back on growth, we could be profitable tomorrow, end quote. However, Peloton's not going to do that because they think the worldwide opportunities here are just too good to pass up. So they're going to be faced with some losses for a while. In a vacuum, I would recommend Peloton right now. That's how fast it's growing, and I like that. Peloton, well, if that last quarter, geez, probably one of the fastest growers in the entire market. But it is a fresh-face IPO in a market that dislikes them right now, especially the ones that keep spending to so-called win, or meaning they lose a lot of money. And then in a few months, they got the lockup on insider selling. That's when it expires. You saw what that did to Uber. When that happens in March, I know that's still away, but people are going to be thinking about it. I expect the stock to get hit. Now, that is probably when you pounce, okay? All right, how about the numbers from Planet Fitness? Much simpler story. I like that. You saw that in the market's much simpler reaction to its results. Last Thursday, Planet Fitness posted inline earnings with higher than expected revenue, up 22% year over year. More importantly, their same-store sales came in at 7.9. Okay, this time they beat because people are looking for 7.2. And they opened 42 new locations during the quarter, bringing the total to nearly 1,900. For the full year, management raised their top and bottom line forecasts as well as their same-store sales guidance. They're talking about 8.6%. Wall Street was looking for 8.4%. Best of all, Planet Fitness had a terrific conference call. Chris Rondo told us that 75% of their sales growth came from new members. That's organic, as their low-key gym brand keeps attracting customers with a more casual approach to exercise. Long-term, he believes Planet Fitness can double its store count in the United States, so much for the people who think there's cannibalization, with the company's deep-pocketed franchisees paying for most of the expansion. That's that asset-light model I like so much. It's exactly what you want to hear. In response, the stock folded 9% on Friday. How did Planet Fitness and Peloton stack up next to each other? Planet's a traditional gym chain. Peloton makes most of its money selling equipment with a subscription kicker, and I like the subscription economy. Planet's got terrific growth for anything you might find in a shopping center. Peloton's in another league. On the other hand, Planet's solidly profitable, while Peloton's losing money, pretty much hand over fist. Now, they both reported great quarters when it comes to growth. Peloton stock didn't behave that way. In the end, these are very different stories. Peloton's the kind of hyper-growth name that the market wants no part of right now. That can change. Got that insider lockup overhang. So even though the company just put up some fantastic revenues, I can't give the stock my blessing here. You need to wait on the sidelines. The bottom line, in a market that favors profitable growth, sticking with what's working, well, you know what? That's Planet Fitness. The stock never should have been down so much over the summer. And even the latest move, it's got more room to run. As for this one, well, I got to tell you, in the end, it can also be kind of a cool exercise cycle. Let's take calls. Let's go to Philip in Alaska. Philip.
Yes, Jim. Greetings from Anchorage.
Anchorage. We got guys from Anchorage calling. What's up?
We don't have any snow yet.
No? I think we're going to get some before you get it. What's going on?
Just interested in one stock that I thought I'd call you about, Restoration Hardware Holdings.
Well, I think that Gary Friedman has figured out how to negotiate the tariffs, which a lot of people felt he couldn't do. They were wrong. They did not understand how good an operator he is. At 172, I think the stock is only $3.2 billion. I have said over the long term it can go to $5 billion. I am not walking away from that. I'm walking toward it. I need to go to Phil in New York. Phil.
Sir, James.
Yes.
Phil
Yes.
in Long Island. Thanks for taking the call.
Okay.
James, Smile Direct Club goes public on September 12th.
Right.
Opens at $21 a share. Mm-hmm. Within the next 4 hours, it sells down to $16.
Right.
Within the next 90 days, it sells down to below $9 a share.
Right. 8 today, right?
So how do the underwriters justify that, and what do you think about the company?
Okay, the conference call was just a complete disaster. I mean, now they're talking about like legislation all over the place could hurt them. They had a glitch in marketing. They're spending a fortune. How do the underwriters do it? How do they let it happen? My friend, they let it happen because there's a lot of money to be made. It's Wall Street. All right, the market doesn't really want hyper growth with no earnings right now like what you get from Peloton. It wants profitable growth like Planet Fitness. But I still believe Planet Fitness got more room to run. And look, I'm not bailing on this Peloton. One day it's going to be good. Right now it's kind of in a holding pattern where it's got, which is the single best way to actually to straighten out a basket. If you don't know that. All right, much more Mad Money ahead. I'm sitting with the CEO of Hersha Hospitality Trust. That's a read of names that you recognize in the hospitality sector when you hear about it, especially from Philadelphia, Rittenhouse. Finding out the business is going strong, 8% yield. Then I spotted an opportunity that's been overlooked. I'm talking about 5G. I think it's misunderstood. But first of all, your calls, rapid fire, in tonight's edition of the Lightning Round. So stick with Cramer.
Don't miss a second of Mad Money. Follow @Jim Cramer on Twitter. Have a question? Tweet Cramer. #MadTweets. Send Jim an email to madmoney@cnbc.com or give us a call at 1-800-743-CNBC. Miss something? Head to madmoney.cnbc.com.